All right, and we are recording. Good morning, Paul. I wanted to thank you for spending another morning with me. It is bright and sunny out, so it's a great day. And what I thought that today, what we will talk about is some of the questions that I get asked quite often for some of my clients and other people who want to get involved in real estate investing. So I figured we'll come up with some of the most common questions and then let me know what your thoughts are from your professional standpoint. So how long have you been a CPA and accountant for?
Long time, Olga. I've been a CPA since 1981. And so not all of that time involved with tax work, but I've been around for a while, and now my partner and I have a tax practice here in Yardley, and we work with a lot of real estate agents and a lot of people who invest in real estate as well. So this is it'd be an interesting topic.
Oh, absolutely. So besides PA and New Jersey, are you able to handle other states? Let's say if investors are having property, maybe like in Florida or Vegas, is this something that you can help making sure that everything's in order?
Sure. Yeah, we have clients that have moved and live in those places. We have clients that have investments in many different states. And so there are differences from state to state and what you're and how you get taxed and all that, but that's not really a problem for us to deal with.
Awesome. Well, I got 2 pages of questions for you, so I'm going to just fire away. So the first one that I'm a big proponent overall of building wealth through real estate. And this is something that I want to be more intentional about helping my clients do the same thing. Whether they buy it for themselves as a retirement home, whether they want to help and have some money to help their parents, or maybe for college, right? For their kids. So the first question is if I buy a home as a primary residence, and then I want to rent it out after a period of time, right? I want my primary to become an investment property. Is there some kind of a rule for how long I have to live in my primary residence before I turn it into a rental?
No, you can, anytime you want, you can turn any property into a rental property. And then it sort of changes from a tax perspective, it changes its character from your residence, where you get to deduct your mortgage interest and your real estate taxes, to an investment property where literally any expense that you have with it becomes deductible and offsets the rent that you get.
So you can still deduct the mortgage interest, right? That doesn't change whether it's primary or investment.
Correct. And so if you own a personal residence, there are limitations on how much mortgage interest that you can deduct. I mean, the amounts are pretty high. You can deduct, for most people, that's not a barrier. But for an investment property, any interest is deductible. And whereas there's a limitation on how much state and local taxes you can deduct these days on your Schedule A of $10,000, you can deduct any real estate taxes associated with any rental property.
Got it. Okay. And one of the questions that I had that is linked to this, that I thought, I don't know, it almost feels to me like a loophole, but I guess if you know the rules and the laws, is if I buy the home as a primary residence, right? I'm going to live in it and I'm going to renovate it. And then if I live in it for at least 2 years out of the last 5, and then I'm going to decide to sell it, right? And my question would be let's say I bought it for 150,000 and I really renovated because I needed this much work, and I sold it in 2 years for 250, right? So it means I made $100,000. Because it was my primary residence, do I have to pay income tax on that $100,000 that was my increased equity in my home?
So first of all, any money that you invest in the house in renovations adds to what's known as the cost basis. So if you bought it for 150 and then you put $50,000 into it, now your cost basis is, or your investment in the property is up to $200,000.
Got it.
If you
Okay.
sell it for 250, you have a gain.
Right.
But if it's your personal residence and you're single, say, you get to exclude $250,000 of gain in a personal residence as long as you've lived there for 2 of the last 5 years. So these days, it's very difficult for somebody to have to pay a gain on the sale of a personal residence. The only examples we see are where maybe somebody bought, really some client's mother or father that bought the house in the 60s for $30,000 or $40,000, and it's turned into a $500,000 house, and there's only one of them, and so even if they put in 30 or 40 or $50,000 over the years, they still exceed that $250,000 exclusion. But for most people that might buy or sell or move within 3 to 5 or 10 years, almost nobody pays tax on the gain of a sale of a personal residence.
Okay, so theoretically, right, if someone who is single or if it's a couple, right, they can do this every 2 years, right? They can
Right.
renovate, and then the gain that they get from renovating the home is their primary residence. So they can technically do this every 2 years and not pay on the gain that they made, right? So the money that they made on the sale of their house.
Exactly. Exactly.
Okay. And I know, and I'm glad that you mentioned with regards to the renovations, because yes, that is your cost of investing into the home. So technically it's not a gain. It is right.
It's your investment, right?
Got
And
it.
by the way, I mean, sort of the other thing is if you renovate a kitchen or a bathroom and you put in, say, $50,000 into the house, in the year that you do that, you don't get any tax benefit. What it
Right.
really does is increase your cost basis so that when you sell it, you're going to pay, you have a smaller gain at the time that you sell it.
I think the only time when it can actually help you, and that's what I suggest to my clients, is for them to reach out to their insurance company, let them know that they did all this, because maybe their homeowner's policy is going to go down because of the renovations that they made. So I think it's always
Or it
a
goes
good.
the other way because the insurance company thinks it's worth more.
Right.
Be
Okay,
careful when you tell insurance
that
company.
is true, actually. But you know what? You always want to make sure that the amount you have insurance on is properly reflected to make sure you're protected. For
Right.
sure. All right. So let's jump into if if I'm actually going to buy an investment property, and may not matter what kind of property it is, are any of my closing costs that I spend to buy that property, are they going to be tax deductible for that year?
No. If you buy, let's go back to an example. If you buy a house, let's say a single family house for $200,000, and there's $10,000 of closing costs, that $210,000 becomes the cost basis for the house. And now, if it's a single family house, you're going to split that between the value of the land and the value of the building.
Mhm.
And the value of the building, then you'll depreciate over 27 and a half years. So every year that you're renting it, you're going to deduct a portion of that cost against your income from that house. So it's a little complicated, but basically you add up all the money that you've invested into the house, whether it's the original cost, the closing costs, or if you put money into it to fix it up before you put it into service as a rental property, and then that becomes the cost basis for you.
What if I had decided to pay some points at closing, maybe to lower my interest rate? Are points deductible for an investment property?
I mean, generally not. If it shows on, you're going to get a statement at the end of the year
Mhm.
from the bank, and
Mhm.
if it shows there as interest or prepaid interest, then yes, it will be deductible. But if it doesn't, if it shows on that closing statement, the HUD-1,
Mhm.
as other costs from loan underwriting costs or something like that, then that would just become part of the basis and would be depreciated.
Got it. Okay. Another big question that I get, and I remember asking the same question when I was beginning my real estate investing path, is, and I think everybody just wants to make sure they're protected. Should I, when I begin my real investing adventure, create an LLC just to make sure that my personal assets are protected? What are your thoughts on that?
So a lot of like a lot of tax matters, it depends.
Hmm.
Um, it it certainly does protect your assets by having it in an LLC. However, it also, if you go to the bank to take out a loan, oftentimes the banks charge more on a business loan than they do on a personal mortgage on a rental property. And so you have to outweigh those costs, or you have to weigh those costs against each other. The other thing is, what a lot of people do is take out an umbrella liability policy. And so you say you have a $200,000 or $300,000 invested in a house, and you've got the insurance, on the property, on the dwelling and on the liability, and then you take another $1 million or $2 million of liability insurance. That might only cost a couple of $100 a year, and that might be cheaper for you than paying more interest on the loan.
Under LLC.
Let me use another example, though. I have a client who is a general contractor, and because he knows a lot about real estate, he puts a lot of his savings into investment properties. He's of the belief that sometime before his career is over, he's going to get sued, not as a landlord, but as a general contractor. So he's more concerned about isolating his business from his rental properties. So he puts the rental properties, each one goes into an LLC, and it's to separate it from the business, not the other way around. He feels like he's protected. He does have an umbrella policy, and he protects himself that way, but he's trying to isolate it from the other parts of his work life, really.
Do you think it also makes a difference if you have one house versus you may have 3, 4, or 5, and then it's a matter of talking about maybe LLC at that point, when it becomes more of a business versus just one house as an adventure to try it out?
Yeah, I think if you're going to try one house, you probably don't need to set up an LLC. But if it's going to become a fundamental part of what you do and how you save and how you earn a living, then you need to treat it like a business. And maybe we'll talk a little more about this before it's all over, the difference between an investment and a business, because that enters into some of the other considerations as well. But the short answer on an LLC is it never hurts, but there's also a cost to it.
Absolutely. I follow a couple of veteran investors that are in our area, and I always learn something new from them. One of the things that they said, and I 200% agree with them, is that they said the question as an investor is not if you're going to get sued. The question is just when it's going to happen. Yeah. And it's very, very accurate. It's very accurate. Right. So cool. Okay. What is the tax rate on income if you decided that you want to flip a home, right? And the flipping a home means that you buy something that needs work, you're going to renovate it, and then you're going to resell it at a much higher value. Is there, I'm just curious to see, does it matter if it's something that I'm going to hold for a while, or does it matter what tax bracket I'm in? Just like, how does the tax is calculated on the flip?
So for most people that I know that do this, they try and hold the house the shortest amount of time that's possible. So they buy the house and they hope to put their renovation into it in sort of 3 to 4 or 5 months. And that puts you under 1 year. And so when you sell it, that becomes a short-term gain, which is taxed the same as ordinary income.
Okay, so whatever the tax bracket you're in, right?
Exactly. It depends on what tax bracket you're in, and it depends on what tax bracket you're in that year.
Right. Okay.
And that can change from year to year. The other thing is if this is what you do for a living, and you do this all the time, then all of those are going to be short term, and that the purchase of that home becomes basically inventory, just like you're buying it, you're investing money into it, and then you're selling it, and you do that again and again and again, and then it's always going to be a short-term income, and it's going to be ordinary income. And then
it turns into,
by the way, it drags out and you own it for a year and a half, and you only do one of these, only do it occasionally, then it could qualify for long-term capital gain treatment. But ideally, when you use the term flip, most people want to make those two transactions happen as quickly as possible.
Right. And then I think when you mentioned that if this is something that you do on continuous basis, it's not like a little hobby or something on the side, it becomes a business, right? And then that's a separate conversation on how to make sure your business is protected, right? And how to run it ultimately.
Right, right,
Yeah.
right.
All right, question about wholesalers. Some of the one of the things that is recommended is if you're not able to find good deals and you don't have the money to buy, because right, that's is one of the biggest things for investors is where am I going to get the money to start my real estate investing? Some people decide that they may want to become wholesalers, and wholesaling is where you are able to find a good opportunity, maybe have a contract on it and then resell the opportunity, that contract to someone else for a fee, right? And it can be anywhere from a couple $1,000s to maybe 5 or 10. How does that get taxed? Is there a rule for that?
That's again going to be that's almost like a commission, really,
Mhm.
that you're earning on that. I mean, if you take title of it and you're um, selling it again within a couple of weeks or a month, that's all going to be short-term ordinary income.
Okay.
And if that's what you do for a living, it'll be taxed as self-employment income as well. So,
See, most wholesalers don't actually take title, right? They don't actually buy it and physically put the money out and then sell it. They find the end user and assign the contract. So what happens is when that end user goes through settlement, there is an assignment fee, right? Like a bonus that is paid to this
so
person.
it's basically like a consulting or a commission payment.
Sure.
And so that's ordinary income and that's going
Mhm.
to be taxed as self-employment income, which is also subject to self-employment tax as well as income tax.
All right. Can I deduct my home office, part of my house mortgage utilities if I'm an investor, right? If I'm sitting here in my family room and I use this as my office for finding deals, handling transactions, can I deduct a part of this room?
So
It
maybe.
depends.
So it's maybe because the home office is deductible for a trade or a business. So if you're sitting at your in your home in your office in a separate room in your house, and you're um, you're buying one house and then you buy another one a year from now, and that's all you really do, then it's no different than buying stocks or a mutual fund at Vanguard. Um, and so if it's investing, you can't deduct the cost of your home office. But if say you do this for a living and this is what you do all the time, and you're buying and selling or you're flipping, then it rises to the level of what the IRS defines as a trade or business. And then that would allow you to deduct the pro rata share of your costs for that home office.
All right. So we're talking about hobby versus more serious actually doing this for a living.
Or even investing
Mhm.
versus a business.
Got
So,
it.
so think of a business. What will you do? So someone who owns even 3 or 4 rental properties and they collect the rent, they do the repairs, that they find the tenants. Contrast that now with somebody who puts the money in and somebody else does all those things. The second person is making an investment. The first person is running a business. So if you run a business, you're allowed to deduct the home office. If it's an investment, it's really no different than putting your money in a bank or putting your money in stocks. And then you aren't allowed to have take those deductions as a part of to offset your income.
Got it. Let's talk about hiring my kids. I thought that was a good one because, I actually do hire my kids now for my real estate practice. They are my marketing assistants, right? Because they do the mailings and the things that I send out to my clients on a monthly basis, and I pay them for it.
Right.
So, what can I do if I wanted to hire my kids for as a real estate investor, right? If some of them are handy and they actually want to work on the home renovation, what can I do?
So if the classic example and the classic way to save taxes by hiring your kids is first of all, if you have a 2-year-old, don't do it because it's not plausible that they're really doing anything. You put them on the payroll. But if they're old enough to actually do some work, whether it's stuffing envelopes or putting
Mhm.
signs out or
Right.
raking the leaves around a rental property, then by all means do it. And the classic way to save is you pay them a wage, a reasonable wage,
Mhm.
and then that gets put in an IRA. And so it becomes the wages are a deduction to your business or your investment, and the income isn't taxed to the child because they've deferred it in an IRA, and they put deposited into an IRA. If you just reduce your business profit and pay your children, and then they have to pay self-employment tax on it, it may actually cost you money, or cost the family money. It may not make economic sense. But there are ways to do it where, particularly if you can have them put money in an IRA that you might not be able to save for yourself. You start them on the habit of savings. You're giving them some long-term, um, a long-term financial foundation, and in a way that, say they're 10 or 12 or 15, they're not going to draw down on that for 40 or 50 years. That'll grow considerably, and it'll grow tax-free.
And are you referring to like just a traditional individual retirement account?
Yes.
Okay.
Yeah.
And when you say paying them wages, does that mean you actually have to put them on payroll? Because then it becomes an expense to you, right? To me, because through payroll, I have to pay social security taxes on them, right? Like I have to pay Medicare. Or the way I'm thinking in my head is like, okay, you rake the leaves, I'm going to pay you $30, like here. When you
Well,
say
if
wages, like what does that mean?
if you're not going to deduct, if you're not going to, you can certainly pay your kids and just the way you would for chores around your house,
Mm-hmm.
but you're not deducting that money, and so it's not income to them if you're not deducting it. But so if you pay your son $1,000 over the course of a year,
Mm-hmm.
and you don't deduct that $1,000 from your business, then it's not income to him. It's a gift.
I got it. But how do I make it a deduction for my business? Because I did pay him $1,000 for the year to do repairs on the house.
You issue a 1099, and then it's
Okay.
income to him, and he puts it on his tax return.
So for 16-year-old, what is the threshold when they actually have to start paying taxes on the amount of money that they earned? Like, is there a minimum? Like they have to earn so much per year for them to start paying taxes on that amount?
Yeah, they'll have to get above the standard deduction amount of $12,000. So, it's a fair amount of money. Now, if they will pay Social Security and Medicare,
No matter what, no matter
no
if
matter
they earned
what,
$25 or 10,000.
right? And just the way if they went to work, um, for the local store, right?
Mhm.
They're going to have that. They won't pay income tax probably if they make a couple of $1,000s, but they'll pay Social Security and Medicare.
So
That'll
that's
be withheld from their pay.
that will be deducted no matter what, no matter how much money they totally earned for the year.
Right.
Okay,
Yeah.
interesting. Okay. Does it matter what state I form my LLC in?
Um, Not really. It's usually easiest to form the LLC in your resident state. If you have, a rental property in another state. So for example, we're on the border here of Pennsylvania and New Jersey, and lots of people do business on either side of the river. So if you're a Pennsylvania resident, probably form the LLC in Pennsylvania, even if it's owning a New Jersey property.
Mhm.
You're still going to file taxes in New Jersey for that rental property, but it might be slightly easier. Now, the one thing to sort of be on the lookout for, different states have different annual fees and filing requirements. And so if you go into a state where you're not a resident and go into one that's got high costs for doing that, then you're taking on that kind of a additional cost of your investment property.
I found it interesting that, because of my one property being in Florida, I issued 1099s to our cleaning company. And I went on the website to see where am I mailing it to, right? Because you have to mail it to the federal IRS, and then you also have to mail it to the state. And there was a note on there is that we don't have income state tax So we don't need your form. I was like, that's like, I forgot, right? So
Right.
it was interesting. I'm like, well, I guess I'm not mailing the state form, but the federal still went in for
Yeah,
deduction.
there's a few states like that, Florida, Texas, Nevada, Washington, uh,
Interesting.
don't have a state income tax. Think about that for retirement, by the way.
Hmm. Okay. Talking about the strategy for, I've heard someone recommend it and I thought it was genius. I wish somebody told me this when my children were born, is when you for each of your child, when they're born, you're going to buy an investment property and you're going to put a tenant in there and you are using that tenant to pay down your mortgage. So that way you increase your equity. Let's say 15 years down the road, right? When my child is ready to go to college, and I need to sell that house or I need to pull the equity out of that house to pay for the college expenses, how am I paying taxes on the gain, right, on the equity that I have accumulated throughout the years?
So, so let's look at two different scenarios. One way to pull the equity out is to do a cash out refinancing.
Mm-hmm.
So that's not a taxable event.
Okay.
You're you're taking a loan that you've paid a lot of money down on, and let's assume the value of the property is increased, and you take out another loan on that property. You take some cash out that you could then use for education. The other one is you sell the whole property. And
Mm-hmm.
so now you've had it for 15 years and you've depreciated it. Remember, the depreciation period for residential property is 27 and a half years. So you've probably written off, aside from the land, you've written off almost half or maybe more than half the cost of the building.
Right.
You're going to pay tax on that depreciation, that you've had that deduction all those years. Now you're going to pay tax on that depreciation when you sell it. And then say the house has gone from being a $200,000 house to a $300,000 house. The rest of that is capital gain. And so if you own stocks and you get dividends every year, you pay the tax on those dividends as you go. With a property like that, you're going to pay the tax on the gain all at once at the end. So if you just think about the value that you've got in the house and the amount of your loan, when you sell it, you've also probably got a tax bill as well to think about.
What is the tax rate on the capital gain? Is that based on your tax bracket that you're in for that year?
Yes.
It is.
Yeah.
Okay.
So for example, a married couple, up to about $100,000 of income, the capital gain tax rate is 0. And then it goes to 15% and eventually gets up to 20%. But for many people, it's in the 15% range. And so that's an advantage compared to ordinary income for most people. And so you would pay less. But then if you were invested in stocks and you got dividends, that would be taxed at the same rate.
The same rate. Okay. So what you're talking about is capital gain tax brackets are different than ordinary income tax brackets, correct?
Right.
Okay.
Right.
Okay. Which ones are less overall?
Capital gains
gain?
always under today's law, capital gains are always taxed at a lower rate.
Lower rate. Okay. Do you think it's a good strategy overall to buy a house use as a rental to help pay for, whether it's for college or maybe to help pay for your parents', healthcare costs down the road?
Sure, absolutely. I mean, the thing is, you've got to have a bit of knowledge of the market and know what you're getting into, and getting advice from somebody like yourself not to overpay on something and what would be a good rental property makes a big difference. If you make the right investment, it's a great way because you're paying as you go. You have a tenant, paying a big chunk of that mortgage. It's a good way, and you're not as tempted to take it out of the bank because it's tied up, right? That's the other thing. Yeah.
Yeah, that's the benefit for sure. All right. Tax advantages to owning a rental property. Let's talk about that.
So the big one we've just been talking about, and that is the ability to depreciate the house. So many people buy the house, start renting it, and then you've got a mortgage on it. And so what they're concerned about is having enough money coming in to pay for that mortgage. And a lot of the times, because you're able to depreciate the house for tax purposes, you might be cash flow positive on a month-to-month basis, but you don't show that income for taxes and you're not paying any taxes on it. So you're deferring that tax and you're paying it when you sell the house, in essence, when the depreciation is recaptured. And so it's tax deferred. And that's a great strategy for people, is to pay that tax later and have the use of the money over the period that you own the house.
So let's say that you buy your rental property, but especially the challenges I know a lot of people are having now is they have their tenants and the tenants are not able to make the mortgage payments, right? Or them to make their rent. And the unfortunate situation is that, the tenants are having a great time of their lives, but the landlords are suffering because they still have to make the mortgage payments, right? So I think a lot of people are going to show a loss on their investments for the year. And can that be written off? Like, can that loss reduce your other income if you have it?
So for example, yes, absolutely. So say in normal years, you're collecting $1,000 a month on a property, but say for 2020, you only got 6 months rent. You're only going to be taxed on the $500, the $600 that you collected, the half that you collected. So it's it's not a write-off, but you're only taxed on the money that comes in. And so it doesn't help you with cash flow. It doesn't help you pay the bank, but at least you're not getting hit twice on something like that.
And to kind of piggyback on that, let's say, the expenses are still there and the end of the year, you are, negative $10,000, right? Because of the tenant not being able to pay. So that loss of $10,000, can that help you reduce your taxable income from, let's say, if you have a regular full-time job?
If you're a real estate professional. So if you're Paul and you do accounting and consulting work and you have one rental property, I'm not able to use real estate losses to offset my other income. But for you, you're a real estate professional. You spend your life all around real estate with investment properties, as a real estate agent. You qualify as a real estate professional and you're allowed to offset current income with losses on a rental property. And so there's a set of rules for who qualifies as a real estate professional. So for example, somebody whose primary job is contracting, that person qualifies as a real estate professional. For someone who does nothing but investing in real estate, that person's going to qualify also. But without getting too technical, there's a little bit of a gray area, but it's actually pretty well defined by the IRS who qualifies and who gets to take advantage of that extra ability to offset current income with rental losses.
So just to make sure I understand you correctly, if you are just a regular engineer and you have 2 rental properties that you lost a lot of money on, you are not able to offset your income with those losses. Is that correct?
Correct. But no, so say in 2020, you showed a loss on those, but in 2021, it comes back and they were rented all year long and you've got a profit. The losses from 2020 would then offset the profit in 2021. So they're deferred or suspended, really is the term. So you get to take advantage of those later, but it doesn't help you in the current year.
Got it.
Unless you're a real estate professional.
So it's important to, I think, talk to an accountant, right? To make sure that you can try and utilize this loss and figure out the best way to apply it and use it as much as you can. Got it. Let's talk about vacation homes, right? If somebody purchased a vacation home and they decide to rent it out, maybe to offset some of their costs, right? Like a mortgage and other expenses. At which point it becomes where you have to pay taxes on the rental income that you get from that vacation property.
So there's actually if you do it less than 2 weeks, you don't have to pay taxes on that at all. We certainly know a lot of people here who own houses at the Jersey Shore and they rent it out all summer.
Mhm.
In essence, that's just like a rental property, even if they use it in the early season or the late season. They'll be able to depreciate a portion of that house. They'll be able to write off the real estate taxes for the period that they're renting it. And you have to apportion it between when you use it as a vacation home and when you use it as a rental property. But you can get current income and you can pay for a lot of the cost of the mortgage by doing that. And that's an attractive strategy for a lot of people.
So if they rent it out for the whole summer, they get income for 90 days. It becomes an investment property, right? Not just a
Right.
vacation home.
That's right. That's
Got
right.
it. All right,
That's right.
let's talk a little bit about short-term rentals and Airbnbs,
Okay.
which is a lot of people are so excited because they understand there's a lot of money involved to it. So what do we need to know?
Yeah. So let's take first, you're doing it with a house where
Mhm.
you're renting it out maybe by the week or something like that,
Mhm.
or for weekends. That's a lot like a vacation rental. If you're doing it with just one room, then it's a little bit trickier. It's just like supplemental income and harder to offset the other costs, like write off the mortgage and write off the utilities and all that kind of stuff if you're just doing room. But if you're doing a vacation rental as an Airbnb, it can be a great strategy. If you think about Airbnb almost as a rental agent for you, it's very
Mhm.
much like having a vacation home that you're doing short-term rentals with. The one thing that you do need to be careful about is in resort communities, there are you're basically running a hotel now, and
Mhm.
there are
Yes.
taxes associated with that type of a short-term rental, and you need to make sure you're complying with the local rules on that.
Yes, I
Um,
have a hotel in Florida. My house
yeah,
is considered to be a hotel, which is
yeah,
just so strange.
yeah.
But yeah, we had to get really, really versed in how Florida hospitality industry works to make sure that we were compliant with what we were doing for sure.
And of course, this used to be the Wild West, and now the hospitality industries kind of lobbied the states to enforce the rules that they have to abide by on properties like this. So it just pays to be informed before you jump into something like that.
Well, if you think about it, when I was doing my research, when we bought our house in Orlando, Orlando has 30,000 rentals, right? And that's besides all the hotels, besides our normal standard hospitality industry. So I think they had to figure out real quick how to manage that and get it all under control. And I wanted to ask you about the individual rooms, right? Let's say if somebody wants to rent a room, maybe to a college student, right? I've seen some people do that to try and offset their expenses. How much money do they have to collect from that college student for that income to become treated as income and needs to be taxable?
I, I'm not positive on this, but my first instinct is all of it
Mhm.
is going to be, if you rent it out for 2 weeks, there's the 14-day period if
Right.
you do it for under that. But if you're doing for a college student, say for a year, then all of it's going to be taxable, and you'll be able to apportion some of the costs to offset that, but all of it's going to be taxable.
Right, because there's going to be lease involved, right? Like in this clear specification of what else the college student is responsible for or not. Because I thought that was interesting because that's what some of the people are trying to do in our area to offset their costs. And if they are close to some of the colleges in New Jersey, I've seen them do that because it helps them, but it also helps the college student, maybe if it's
Right.
one or two people.
Right.
So, okay. Let's see what I had. Is there anything else that I did not ask that you think you want to mention?
Well, the one thing that I get asked often
Mhm.
is this concept of a 1031 exchange.
Okay.
And what's a 1031 exchange? And I've heard about it, and should I take advantage of it? So very simply, this is when you have a property and you want to sell it and you want to buy another one. And you've bought it for $200,000 and you're going to sell it for $400,000. You'd have to pay a lot of tax on that. If you buy a property for the same or greater value than what you're selling it for, you can elect to defer that gain and pass that gain on to the new property. And so there are a whole lot of rules about how to implement that. And you absolutely can't touch the money of those two transactions, the sale and the purchase. And there are rules about identifying the new property and the closing dates on those properties. But the most fundamental rules are, if you're buying a property for more money and you're taking on a loan of at least the same amount of money, then you can defer that gain and not pay the gain when you sell the first property, and it lowers the basis of the second property. So the one thing that everyone needs to do is have an intermediary that will manage that transaction for you. But it's a tax saving, it's a tax deferral strategy. Again, if you can not pay the tax in 2021, but if you can pay it 5 or 10 years from now, you've got that the use of that money in that interim period, and that's a good thing for you.
But really, all it is you're just deferring paying the taxes on that amount for a number of years.
Right.
I think it's tough to do, especially right now, because you might really do great by selling the property because there's a shortage of inventory right now. However, to find something that makes sense as an investment right now is almost impossible unless you have the connections and you buy something that's off market, right? But anything that comes on the market, you are going to be competing with retail buyers, and it's very difficult to make that investment worthwhile when you try to run the numbers. And most of the decisions that are made right now are emotional. I have to have this house and I'm going to overpay for it, is what I'm saying.
So you're buying and selling in the same market, and that
Right. And right now it's very, very difficult unless you have access and you know somebody who does not want to put their house on the market and they want to get out, and there's a great opportunity for you.
Right.
So, and those are not easy to come by either.
That's right. Yeah.
Well, these are all the questions that I had. I really enjoyed it because that actually answers some of my questions and actually supports what I do know to make sure that I am still staying on top of these things. This is why I always call you, because you are, have a direct access to the IRS and you always stay on top of all the changes, because I think they happen all the time, especially with, what we have going on in the country with the pandemic. So I very much appreciate you and everything that you do, and your willingness and ability to text me back and call me back when I am like, oh my God, what do I do? So it's very much appreciated.
Well, enjoy talking with you this morning.
All right. Thank you so much, Paul.
All right. Take care.